All right, welcome everybody. Give a minute here to get connected. Thank you for joining us for the loan officer training. Give it a minute while we get live on all the different platforms. If you have a chat, you can throw it in the chat there. All right. Welcome, Matthew. Good evening, everyone here. All right, looks like we are live. Let's go ahead and get started. So welcome everyone. My name is Nick Hershey. I'm the president of the Mortgage Calculator. We do these loan officer trainings every Tuesday and Wednesday for our team and anybody else who wants to join. Today, Jose Gonzalez, our sales manager, is going to go over our DPA options and some of the limitations there for our team and anybody else that would like to look into them. So definitely a lot of misconceptions going in here. Make sure everybody understands what they can do and what they can't do. These programs are definitely not what most people think they are. So let's go ahead and have you get started here, Jose, and break down exactly how we can use these to our advantage.
Awesome. Good evening, everybody, or good afternoon, depending what part of the country you're in. Or if you're in Hawaii, maybe it's not even lunchtime yet for you. Uh, Down payment assistance is definitely somewhat of an aphrodisiac, I would call it, in the lending world, in the financing world, right? Because, I mean, everybody has their preconceived notion about what it is and what it is not, right? I mean, just the name in itself is pretty self-explanatory, right? It is down payment assistance, but it is not necessarily just for down payment assistance. They should really call it closing cost assistance or purchase funds, cash to close assistance, because really it's not just for the down payment. It just helps you with the funds that you will need to use for the transaction. So maybe they should call it uh, closing the transaction assistance, right? Because it could come in a number of different ways, as you will see in the options that I'm going to offer. Going back to the preconceived notions, there's preconceived notions that it's income based only or only for first time home buyers, very difficult to obtain, only when there's funds available. The funds come and get depleted really fast. So those are our preconceived notions, and some of those notions do have truth to them. However, they are not uh, to encompass the whole realm of what this type of assistance can be used for. Right. So let me share my presentation with you. Let's talk a little bit about what down payment assistance is and how we can all use it to increase our loan production, and more importantly, how we can use it to help our borrowers achieve the dream, the American dream of owning a home. It could be their first home, their last home, but just purchasing a home rather than renting. We know how tough it is right now in this environment. Rents are going up higher than the interest rates, right? It's cheaper to own and pay a housing payment rather than rent in most cases, in most markets, right? You can control your housing expense a lot more effectively if you're the owner than if you are a renter. So let's break it down what it is and what it isn't. There's basically two types of down payment assistance that you can obtain. The one that most everybody thinks about is the excuse me, the quote unquote free money, right? The one that is usually doesn't have any type of a repayment at all, right? Now this option is usually going to be locally based and is going to be funded either by the city, the county, or the state government, wherever the borrower is located. Every so often, municipalities, county governments, state governments will set aside a little bit of money they have left over, and they will put it into an affordable housing program, and then they will manage that program, and then everybody will run to it, right? And everybody will apply, and then you have to practically jump through hoops of fire to qualify for the program. Those programs,
before the money runs out, right?
yeah. That's a problem. That by the time they're done jumping through the multiple hoops of fire, the money has run out. It's not that money to begin with. It sounds really good. I mean, it is a good, very good cause, but unfortunately, not enough money is usually set aside for the program to really put in any type of a sizable dent in the amount of people that really need that type of assistance, right? And usually it's going to be the person who may be on some type of subsidized housing is going to be the one that's going to be first in line for that program because they're the ones that really need it the most, and these programs usually you'll hear about them. The really good ones, right? The ones that the people would really love are the ones that like will have like 30 or 40% of the purchase price as the forgivable type loan, that there is no repayment option at all as long as you stay as an owner occupant of the home. A lot of times also those programs, those homes tend to have restrictions on who they can sell the house to also, if it's still being financed by that program when they go to sell the house, right? They don't want that person to be really making too much of a profit. So it would have to go to a similar type of lower income type individual. They want to keep, uh, passing along the assistance that was originally generated by the loan. So again, it's definitely income based. Definitely wait in line for your turn to come up when the money is available. When the money's out, you still have your voucher, quote unquote, available to use the program. You're just waiting around for funding. And those programs do also require home counseling courses to be taken, not like a 1 hour course, but like a course, to be taken. That's why it takes a while to get approved by the program. And then, once you're approved, then you have to wait for the funds. So on the borrower side, it has those limitations that can make it rather frustrating. You could be waiting a long time until the funds are available for you to exercise the use of the program. And on the company side, as a loan originator, for those of us in the audience today that are loan originators, that I'm assuming most of you are, this option will require the loan originator and the company to be approved to offer that program. What that usually means is that you have to be local to that market to offer that program as well. Because if you are a national company, you cannot really be offering a localized program and offering those types of benefits and stay in compliance with your national lending needs and national lending requirements. That's the biggest challenge of participating in these localized programs. Are do you want to just concentrate on only offering that type of program only and nothing else, or do you want to offer a broad lending, broad spectrum of products? Right. That's really what it boils down to. Because on top, when we're talking about compliance, as loan originators, as lenders, we have compensation agreements that we have to abide by that we just cannot be flip flopping on from one loan to the next. That's against the law. Regulators expect us to abide by the agreements that we have so that we do not discriminate against borrowers. There's a purpose to that, right? So you see how we continually have people approach us about these programs, and that is the challenge. How do we participate in that program and run your business in compliance with the lending laws? So again, uh, food for thought there. So that's one type of program, and that's the one that usually comes up to your average citizen, or to the MLOs, when they see, oh look, they just released such and such program in this city, and I have a borrower from that city, and they said that they qualify for that program. Well, they're probably going to have to go to a local lender that's specializing in that program if they're going to use that program, which is going to be income based, need based, right? And then is also going to put requirements on the originator and the company on who can offer it. It's not just being approved by the conduit that offers it for you to be able to offer it. You have to be approved by the city, the county, or the state, or the organization that's going to be a local organization to be able to offer it. So that's one type of down payment assistance program. The other type of down payment assistance is more of a national program. National option does not require the MLO nor the company to be approved by the program, only to be approved by the conduit that offers it. Whoever is the investor, quote unquote, on that loan. We sell our loans to investors. Investors offer these options. So whoever is the conduit for the money is who we would have to be approved by, so that we could offer that. Usually, these programs are actually done on a brokered basis, right? They are the money source, and they allow us to broker it out. And that is the good thing about these programs, is that they're national. There are no income limitations on who can participate in the program. That's very important. There's no first time home buyer restriction either. That's also very important. So now you see how these programs can actually offer a much wider group of people. Mind you, it's not going to be 30 or 40% of the sales price that's going to be covered by a forgivable second mortgage that they don't have to be making any payments on. But the amount of people that are really offered by those programs are minimal. It just sounds really good, but very few people are actually helped out by those programs. There's a much broader spectrum of borrowers that are able to take advantage of the no income limit, no first time homebuyer option, which does offer repayable and forgivable options. So it's not all, it's not all bad. It's actually very good. There's a lot of flexibility
Well,
in this.
before you get off this one, Jose, can you talk about how this affects the purchase contract? Because that's really what gets the short end of the stick here, especially on the local end. So can you just
Yes.
explain how the local and the national differ on how you actually structure the purchase agreement and those challenges?
Absolutely. Thank you for bringing that up. The localized version is usually going to be administered by some type of agency, which after the first loan is underwritten and approved, then the loan package needs to then be submitted to this agency to be underwritten and approved, to have the second mortgage underwritten and approved, to make sure that it abides to all with all of the requirements, underwriting requirements for that program. Remember, this is not just being approved for the first mortgage, but now you got to be approved for the program as well for the second mortgage that is going to issue a good amount of the money for the transaction. Like I said, a lot of times it's 30-40% of the purchase price. And what that does there is that adds an additional process, which adds additional time to the transaction. Could be 30 days more. We're not talking about a privately run organization here that's working on a for-profit basis. Time is of the essence, right? We're talking about a nonprofit, governmental or pseudo-governmental agency that is just going to be done when they're done with it. So you could be looking at an additional 30 days processing time on the loan. So if you're in a market that is, low inventory, where typically you're not going to land a home unless you have a 30 or maximum 45-day closing period on your offer, these types of transactions may require, 60 days or longer to be able to close.
I
So
would
that
say realistically, regular DPA, you might want 60 days on the contract, but that local DPA, you're going to need 90 probably at minimum, I would say, to be safe. And that's just going to be counterproductive to landing a quote unquote deal, correct?
Correct. I mean, there may be certain type of properties that this would work with. Maybe a new construction in a area that's being gentrified, where the developer can wait because the home is in the process of being built. So you may have more time. That's usually where you end up seeing these work out, because it's tough on the resale market to have 90 days for a closing. That's just very, very, very tough. Right now, we have a very limited inventory. Continually, we see contracts where they want to close in 20, loan approval, a contingency period, 21 days, closing in 28 days. They don't want to mess around. They want to know quickly if it's going to happen. You have to show strength in many different ways, and that's one of the ways to show the strength is going to be in the period that it's going to take to close the deal, the financing contingency period as well. So you could discuss this with your local agent, whoever is going to be assisting you or your borrower, to see the viability of the program. They're going to be the one that are going to have the greater insight on what may be possible to structure one of these deals. So before going on this mission, I always recommend consulting with the real estate agent that's going to assist you to see what's the best way to deal with this.
Exactly. Imagine waiting 45 days, 90 days for a voucher to realize that your voucher is worthless for the home that you really want, right? So that would just be counterproductive to wait all that time for a voucher that really can't be used when you talk to the agent, right?
Absolutely. Now, some people may not have a choice to be able to try to buy the house that they need. But again, yeah, you definitely got to speak with your agent to see how this can be structured so you can actually take advantage of it. Because if you're just shopping around your local neighborhood and not taking that into consideration, you may run into a lot of obstacles. Namely, nobody wants to take your 75 or 90-day closing contract, right? Versus the other option, which is two mortgages, but not the same type of setup, not as bureaucratic, so it will close quicker. Still is two separate mortgages, but you can definitely close it quicker, especially if you can get the first one done in 20 days or something like that. Then you can get the other one done, and maybe you'll be closing in 45 or maximum 60 days, but it's definitely not 90 days or longer, as can be the issue with the first option that we mentioned. So the national option has a lot of benefits, and it's a more user friendly option. I mean, frankly, if you're going to qualify for this type of option, you probably would not qualify for the other option that really requires you to be in serious financial dire straits. It's meant, they're not going to give away 30 or 40% of the purchase price of a home to somebody that can afford it. Just because you only have 10 or 12,000 or $6,000 doesn't mean that you don't have a job, that you don't have income, because the other program is not really meant just to help people that don't have the money. It's to help people that can't afford to make that higher monthly payment. Hence, 30 or 40% of the purchase price doesn't require a payment, right? So it's a dual purpose there. They're helping you with having to come up with less money, and also helping you by allowing you to make a lower payment. So if you're going to qualify for that program, I guarantee you would not or if you're going to qualify for the second option, which is the national option, you would not qualify for the first option, which really does require you to have some serious financial hardship. So, but you can see, as a loan officer, as a loan originator, you really need to understand what is possible and what is not possible, so that when your borrowers ask you about these consultations, you are able to provide them accurate information, empower them, so that they can make the decision that they need to make. I mean, a lot of times it's pretty cut and dry what's going to happen. So let me break it down a little bit here into the options that we have. We have a repayable option, right? Now, this is always used in conjunction with an FHA first mortgage. That's the first thing you have to know. Now, this option is not going to allow you to go to the maximum FHA DTI of 56.9, right? This option is maximum 50% on an automated underwriting approval, right? That's automated underwriting approval, 50%. If your deal requires manual underwriting, then, like every other manual underwriting deal out there for FHA, your maximum DTI is going to be 43%, right? So very important for you to note that. Um, Also, if you're a first time home buyer, there is a limit of 43%. And if you want to go above 43% DTI, you then have to take the counseling courses, the home counseling courses that would then allow you to take it up to the 50% DTI, assuming you receive an automated underwriting approval. This option does require a minimum 660 credit score. But like I mentioned, when we're talking about right now at the onset, no income limits nor first time home buyer restrictions. That's very important, because most people have a preconceived notion that FHA loans in general are for first time home buyers. And that is just simply not true. FHA loans are just FHA loans for primary homes, right? Now, it can be for FHA, not necessarily the DPA. For FHA, it could be a 2 unit, 3 unit, or 4 unit. Now, there are restrictions on the DPA. I believe they allow a 2 unit purchase, but I believe they do not allow, pretty sure they do not allow a 3 or 4 unit purchase with the down payment assistance, using down payment assistance. Now, again, I mentioned down payment assistance. They say down payment assistance, but it's really, I would call it funds assistance, right? They're assisting you with the funds necessary for the transaction. Part of the funds for the transaction is your down payment, minimum 3.5%. And the other part of the funds is your closing costs and your prepaid expenses. What are prepaid expenses? Would be your insurance premium, uh, and the prepaid interest for the month that you're closing, the escrow account that the lender will establish for you for the taxes and insurances, whatever insurances the property may need, right? Those are your prepaid. So it's closing costs, prepaid expenses, and down payment are the funds that you will need for the transaction. Now, real important to know that these programs are offered as a second mortgage, right, with a 30-year amortization. But here is the key, and this is something really important to convey to the customer. It is due in 10 years. Basically, at the end of 10 years, there's a balloon payment, and you either have to refinance, the loan into, that loan with your first, get a new first loan, which they probably would have done anyhow, or you need to pay it off. That's simple as that. It is a balloon payment. It is at a 9.99% rate. And the maximum assistance for the repayable option, we have an assistance equal to 3.5%. On this one right here, 3.5% of the lower of the appraised value or the purchase price. So 3.5% just happens to equal your down payment. But if you have your 3.5% down payment, this 3.5% is going to go to your closing costs. It's just semantics, right? It's 3.5% or the funds assistance that you are getting for the transaction, right? So that's why I put there. It may be used for up to 100% of the borrower's cash requirement. You cannot get any cash back. So if you put a deposit, or if whatever you did and you're putting money into the transaction, you cannot, if there's any money left over from this assistance, like if your closing costs are so low that after you putting in your required 3.5% transaction into the deal, there is money left over, like if you have seller contribution and different things like that, you cannot make money off of this down payment assistance program. Any monies left over would have to be given back. That's simple how it works. And it is not possible to use this option for a cash out refi. Simply not possible. So this is our repayable option. So let's talk a little bit about the forgivable option. The forgivable option has a minimum credit score of 620, maximum DTI of 50%. Now, there's no payment, there's no interest and that is accrued, and no payment either for this forgivable option. But the key is that the property must remain owner occupied through the 60th payment of the first mortgage. And if you are up to date on the first mortgage, not delinquent after 60 payments, then poof, it goes away. They forgive it. Now you ask yourself, why would somebody not always use this option over the repayable option? Well, in tomorrow's training, I'll show you why, where we actually structure it and show you some quotes. But I'll briefly explain it now, is that the interest rate is lower on the repayable option than it is on the forgivable option. As we know, on these DPAs, they tend to include some of the cost of the DPA into the first mortgage. So what happens here is you have a first mortgage that's probably going to be at least 1% higher in rate than the repayable option. And should you not refinance this loan after 5 years, let's say, after the forgivable option goes away, you're like, okay, I'm good. Maybe you can refinance it. Maybe you're not in a position to refinance it. But then that means that you're going to have that higher interest rate for as long as you have that loan. So you'd have to factor out what is the difference monthly in your payment over 60, 90, 100 payments, let's say. comparing the forgivable option to the repayable option and see where that puts you, and how long is it going to take for the free money to quote unquote run out, and now all of a sudden you're in the negative due to having much higher payment. Depending on your loan amount, that 1% could be 100 and something dollars or more a month difference in your payment. So after 60 months, that's could be 9 G's, 10 G's, and how
Yeah.
much are you really going to get in the forgivable option, right?
Nothing's free, right,
Yeah.
Jose?
Yeah, absolutely. Now, I will state now the reason we like using this DPA, the reason it's really the only one that we use is not only because it's national, because there's quite a few national options out there, but I guess I should have made this mention in the onset. It's a lender paid option in that the there's not a there's not a separate broker fee that has to be either paid by the borrower or try to negotiate to get it paid by the seller as seller contribution. So that sort of negates the benefit of having down payment assistance. Why would you have a program that now forces the borrower to pay the compensation out of their pocket, and or try to force the seller to pay it, which is usually going to increase the price of the property when you're negotiating the deal? It just doesn't make sense. This option is really the best of both worlds. It's a lender paid option, and what we mean by lender paid is that the compensation is paid to the loan originator by the source of the money. That's putting it in simplistic terms there, uh, as opposed to charging it to the borrower, right? It's built into the rate already, and the rate is going to be lower either way than the rate that you would get for some of the other options. So keep in mind then the repayable option, how it works out, and the forgivable option, but that this DPA program in general, whether it's a forgivable option or the repayable option, is all lender paid. There's no separate broker fee charged to the borrower. So it is true assistance, how we see it, right? You don't say, okay, well now I got to figure out how I'm going to jump through another hoop of fire to be able to get 3.5% of the purchase price to help me out. Now I got to ask the seller to give me, 2% or 3% to cover additional expenses that you would not incur, only because you're using that particular option that doesn't have lender paid compensation. So, but getting back, excuse me, to the difference between the forgivable and the repayable is that the repayable is a lower interest rate. That's the main kicker. Now there is another way that we can use this program, and it is the repayable option that affords up to 6% of all costs. Now you're seeing here, this option is really good. This option really would allow you to cover, depending what the closing costs are. Just think about it, right? If now the only catch here is that the borrower must have 3.5% of their own funds for the transaction, because FHA requires minimum borrower contribution of 3.5%. I mean, there's other ways around it when we're talking about gifts and all that, but for this type of a deal where it's coming from down payment assistance, if you're going to use, get 4%, 5%, or 6% down payment assistance, the borrower does have to come up with 3.5% of their own funds. But ideally, this means that if they have the down payment, they can cover the complete closing costs without having to try to negotiate seller contribution, because we know how difficult that is. It's tough enough landing a deal in your hotter real estate markets with limited inventory when you are throwing out offers out there with seller contribution. So remember, what we're trying to establish here is landing the deal. How does the borrower land the deal? And when you have multiple offers on a property, right, and the seller is considering 5, 6, 7, 8 offers in one shot. Okay, maybe they're all FHA offers, which is fine, but then you have offers that are asking for seller contribution, and then you have offers that are not. So, and when the sales price is the same, the ones that are not asking for seller contributions are the ones that are going to get the deal. So, yeah, I mean, if you can get seller contribution, great. You may not need as much of this money. But right now, in the market environment that we're on, in most markets, I'm not saying all markets, so this is also a localized situation where you would need to reach out to your real estate professional and consult with them, and they can recommend to you based on the experience you're having in the localized market. Is it going to work? I know some markets that are actually, a little bit of a declining markets that may be more viable. I see every now and then a contract come by my way that has some seller contribution, and I'm like, oh wow, great. They were able to get some seller contribution, but that is few and far between that can actually get that. So this strategy here is not just a strategy of being able to get down payment assistance, is being able to use down payment assistance for a borrower that normally would have tried to get seller contribution, that has been frustrated for the last 6, 7, 8, 9 months. Man, I put out 100 offers. My realtor got tired of working with me, and the second realtor, because they got tired of putting out so many offers that they just couldn't deal with it anymore. So now you don't need to do seller contribution. If you have your 3.5% of your own money, you can use this option to cover all your closing costs and be good with it, right? It's the same type of a scenario as the repayable option, 9.99% rate, 30-year amortization with a balloon due in 10 years. Maximum 50% DTI, 660 credit score. Now, this one does require LP or DU approval. This one does not allow manual underwriting because it's, could be up to 6%. They don't want to take the chance. But again, like the other ones, no income limit, nor first time homebuyer restrictions. Again, it's a lower rate than the forgivable option on the first loan, right? So a lot of good things happening here, because what good is it if you don't land the deal, right? If you don't get the contract, 100% of nothing is nothing. You're not going to get it. You could keep trying the same strategy over and over and over and over until maybe one day you find somebody that accepts it, but maybe it's not the house you really wanted. Maybe you had to settle for the house nobody wanted just so you could land the seller contribution instead of getting the house that you really wanted by not having to ask for seller contribution. There is a real intrinsic value in being able to get the home you really want, in the neighborhood you want, in the condition you want, and be happy with making the payment, rather than saying, oh yeah, I landed the deal with seller contribution. What does it matter? How much is it really going to be? 3%, 4% of the sales price. You're still going to have to come up with your down payment, your 3.5% of the purchase price anyhow. So, this is another great strategy. So what we're offering here with the down payment options that we're offering are strategies for our low down payment borrowers, typically our FHA borrowers, because this is only for FHA loans, can only be combined with FHA loans, to be able to land a deal, right? To not be frustrated, to have a little bit more power when you're making those offers, to have a stronger offer and hopefully get your dream home.
All right. Thank you, sir. I see one question about, is this Dream Home Second? I mean, every lender has different names for the programs. Remember, the national programs are going to be the Native American programs are typically the national programs, because remember, it has to be an organization. So the only national organizations that can offer these DPAs are typically the Native American Fund organizations, as they're the national version of what the other programs do locally, right? So it still needs to be some sort of compliant organization. So the spin that you put on it is going to be different. The rules that Jose went over are going to be unique to a couple of our outlets. However, they're all going to use kind of a similar structure there. just depending on the branding and the brand name.
What I can say about this program is that it does not have a limitation on the compensation. So typically, most outlets out there are working on a 2.75% margin. This one allows you to work on a 2.75% margin. That's very key. If you're running your operation on a 2.75% margin, you can't just change it for one program. If it's lower than that, you would have to alter the complete compensation structure of your organization to be able to participate in a program that is less comp than what you're legally allowed to make per your agreement.
Exactly. It gets complicated, guys. But I don't see any other questions, so I think we can wrap it up. Tomorrow we will go over the loan structure for DPA and talk a little bit more numbers, talk a little bit more of actual quotes, put some stuff together on paper so you can see what the actual monthly payment comparison, as Jose explained, breaks down. So you can see, is it the magic pill that everybody thinks it is, or is it not? And then which version is better, right? You want to make sure you understand it so you can analyze it. As Jose said, is the forgivable option actually going to benefit our borrower if they're going to move in 1 year, or is the non-forgivable option going to be better if they're going to move in 1 year, right? We need to make sure we analyze the options so that we give our customer a true benefit, right? You can get stuck, as Jose said, at 1% higher rate for 30 years just by not analyzing it correctly and giving them what could have been maybe a better option. So please check it out tomorrow. We'll be here 7 p.m. Eastern for part 2. And thanks everybody for joining us today. And thanks, Jose, for the presentation.
Thank you, everybody. Have a great night.